Cool. Okay. Welcome everybody. We'll wait a couple of minutes before we get down to it, but just to go over the agenda and what we're doing here. So Nick and I became friends, a couple of weeks ago, Nick?
Yeah, new friends.
And I've been super interested in real estate, gotten bad advice, read bad material, don't quite understand it, and super intrigued by Nick's background, and he gave me a quick schooling on the first call we shared, and talked for a couple hours after that, and decided that it would make sense to continue the education in public. So that's why we're putting this on. And Nick's got some great material on all things real estate, and we're going to dive into one of the most fundamental principles within his expertise, and that's the use of leverage in real estate. Nick, I'll let you give a little bit more of an overview, but this is the list of topics that we're going to try and cover today.
Yeah, Jack's the visualize expert. I'm a self-storage owner and operator in the commercial real estate space. We have about $20 million of self-storage that we own as a group with outside partners and a lot of leverage as well. And we got a lot more under contract. We're going to be buying 12 more properties in the next 3 months. So things are busy, but our goal is to build a portfolio. And today we're going to talk about how to use banks and debt to amplify your appreciation, your cash flow, and what you can do with real estate, and also some of the risks that come along with that. And if we have time, we're going to talk about the almighty cash out refinance and some tax advantages that go along with this stuff. But I'm excited. Jack knows more than he's let on. He and also what he does over Visualize is phenomenal. So I feel pretty honored to be here with him.
Likewise, man. It's going to be fun. All right. So we have an hour on the calendar, but I think the two of us both have a little room on the other side. So there's a Q&A box. Get your questions in real time. We may not answer them in real time, but let's make sure that you just get them recorded so we can come back to them. Let me get my do not disturb going here. How do you even do that? There you go. And we'll get back to them. But what we're going to do is try and stick as closely as we can to this agenda. So I'm going to be asking Nick questions, and we're going to try and make some visuals for each of these different stages of telling this story. So why don't we get into it, Nick, with the foundational piece? Tell us how we can figure out how to value real estate.
Yeah, so homes, when you buy a house, you get an appraisal done, and the appraiser looks at what other homes sold for. And we're going to talk about real estate where you can value them based on how much money they make, which is not necessarily single family homes, but even if you do single family home real estate, this is a good concept and framework to start to think about real estate. And the bottom line is that commercial real estate comes in a ton of different asset classes. We have self-storage, trailer parks, mobile home parks. We have office buildings, all types of different real estate. This stuff applies to all of them. I'm going to talk about self-storage today because that's what I do. But yeah, it's basically valued based on how much cash a property makes. So it's not necessarily comparables, but whereas the multiple of that cash that you make, which in our terms is called the cap rate, basically you divide by a negative or a percentage to get the overall value of a property based on how much cash that it makes. So we're going to talk about some ways that you use that stuff to tell how much it's worth. And the great thing about commercial real estate is that you can control it.
Awesome. So just to try and visualize what you just explained, traditionally there would be, these are 3 properties on a street, and this one's 200,000, this one's 210,000 because it has a bathroom, like a better bathroom. This one has a pool, so it's a little more. But what we're talking about is what the cash that an asset produces on a typically monthly basis, correct?
Yeah, we'll talk about it from an annual basis, but yeah, it's monthly or annual basis, and it's called net operating income. So there's revenue that comes in from a piece of property. That is the rents that you're charging tenants, and everything below the line is the expenses that you are spending, the money that you're spending to operate the piece of property, which for us in self-storage, that's marketing, that's management, that's on-site payroll, that is our software packages, it's our property taxes, and it's our insurance. All those things come out of the revenue that you charge or that you bring in the door, and you're left with net operating income. That's profit. Net operating income is the profit that a piece of real estate makes. And that is the figure that is used to value real estate. So if you have $1 million piece of property that makes $50,000 in net operating income, then it's valued based on that multiple, basically 20x.
Okay, so tenant pays X to lease a certain amount of space. If that's self-storage, that's a unit or a couple units or whatever else, minus what it costs you to market the business, run the business, pay staff, et cetera, and that's what's left over there is your net operating income. That's supposed to be a broom, by the way, if anybody's so the sum of all the payment you collect from your tenants minus what it costs you to operate the business equals your net operating income times 20 would be the value of the property. Is that about right?
And the cap rates work as an interest rate on overall spend. So if you're looking at a $50,000 net operating income, and it's $1 million property, it's a basically 5% yield per year. If you owned a bond of $1 million and you get 5% clip, that's 50 grand. So it's actually used by cap rates. We're going to talk about it in multiples because it's easier to understand. But yeah, for a lot of these examples, we'll talk about a 12 to 20 times multiple, the way real estate's valued. But it's actually a cap rate, which is a percentage yield that you get on overall spend. So if you spend $1 million and you get $50,000 a year net operating income, you're basically buying that piece of property for a 5% rate. So the cap rate is equal to 5%.
Yield on the full value of the
overall
property.
Spend. Yeah, the cost. Yep. So if you spend $1 million to buy a piece of property and it brings us in $50,000, that's a 5 cap. That's an expensive in real estate terms. I try to buy 8 caps, which would give me $80,000 of net operating income on a $1 million spend. When you're buying, a high cap rate is good because you're going to get more yield. A 10 or 12 cap means you're going to get 10 or 12% return on your overall spend. But if you're selling, you want a low cap rate because the net operating income that you have in place means more value and more a higher price that you can sell your property for.
I think we might need another slide just for this piece. So I know we said we want
cap rates. There's a lot of nuance. There's a lot of nuance around cap rates. I think spending a couple minutes on this is important, but there's a lot of nuance around cap rates. Cap rates go up if they're deemed more risky. Cap rates go down, lower yield, if they're deemed lower risk, higher probability of more yield later on. So there's a lot of nuance around cap rates. We won't get into them a ton, but that's how you value commercial real estate.
Okay. If you got questions, put them in the Q&A instead of the chat, by the way, because they're going to disappear if they're in the chat.
Yeah, people are asking about the risks associated with real estate, and any piece of real estate that you buy has risk, right? If you're in Austin, Texas, the future prospects of your property are good. People are moving there. There's a good likelihood that your revenue is going to go up over time. So people are willing to take a lower cap rate to make up for that. If you're buying a piece of property in Syracuse, New York, that has been shrinking for 20 years, and the prospects are not that good, you might buy it at an 8, 9, or 10 cap to associate more of that risk in place. So we don't have to talk about that too much, but basically the cap rates are used to determine the value. So we're going to talk about, around the 5 to 8 cap range is what most real estate trades at nowadays. But, in downtown, Atlanta or Austin, you're seeing 3 and 4 caps because people are willing to spend more for lower yield because of less risk.
Okay. Now I'm getting it. So the higher the cap rate, let's say 8 to 12, is you would look at that as a riskier asset potentially.
Yes.
The higher the return, the higher the risk.
And less prospect. It's all about, cap rates include the prospects of future yield as well. It's kind of like a market, right? It's like the stock market. If a stock is deemed that everybody thinks it's going to go up and get more valuable, it's going to trade at a lower yield on overall cost, the price per earnings or whatever it is. But if the prospects are looking slim, then it might trade an 8 to 12 cap if there's not a lot of investors that want to buy it.
Okay. And how does the cap rate translate to the price? This is where I'm getting stuck. So
Yep. So it's a percentage. So, and you divide by a percentage. So if it's 50,000 in net operating income, and we're going to divide it by 0.08.
Yeah.
50K net operating income divided by 0.08 is $625,000 value. But if we have the same asset and it's in Austin, Texas, and it's trading at a 3.5 cap, $50,000 divided by 0.035, $1.4 million that people will pay for that same $50,000 in yield.
Okay, we had Austin, Texas, and is this like a self-storage facility? Is that fair?
Yeah, it could be a multifamily, a big multifamily project, a giant office building before COVID, things like that can really, impact risk.
Okay, so let's say this is in Austin, Texas. That example above, what would you say that? You said Syracuse, or like a city that's shrinking.
Yes, a small dying town. Cleveland. Put Cleveland on there because investor appetite in Cleveland, Detroit, cities like that has really changed.
Okay, I think hopefully that clears it up for the audience as well, but that helped me get my head around it.
Yep, let's rock.
All right.
0.08. Yeah, that the cap rate there is 0.08, not 8. So it's a percent. Yep, got it.
Got it. All right. Beautiful. Okay. Right, let's go back to the agenda and let's hit that next piece. So we talked about, I think we've covered risk, but now we want to talk about leverage. So let's get to understanding what leverage is in the context of real estate.
Yep. So the good thing about commercial real estate and any piece of real estate is that banks will lend openly on these assets because you can see them, you can touch them, they're there, they're deemed a lot less risky than other investments that you can make. So if you have, $1 million to invest in real estate, you might be able to buy one piece of property for $1 million, or you could buy 4 different properties and put in $250,000 of your own cash, and the bank can finance 75% of the additional expense. So now leverage basically just means, hey, we're gonna get a bank to put in part of this purchase price, and that's the collateral that they're gonna hold is that piece of real estate.
Okay, so let me catch up with what you said here, but let's assume that you have $1 million in cash. You can buy an asset, market value of $1 million, put 100% of your money in, and you would own it outright, right? In the other scenario where we deploy leverage, you can identify 4 properties with $1 million value and split your capital across those properties, right?
Exactly.
And the bank is gonna pick up the tab on the rest. So let's use this as a so the solid color is your money, and we're going to stay black and white here so I don't get caught up switching colors, but this 75% is borrowed money. All right.
And banks lend anywhere from, some investors put 50% down and get 50% leverage. That's less risky. Some investors put, 20% down or 10% down and get, a lot more leverage. So you lever these things up to different levels, but for this example, we'll use the 25% our money in.
Okay, cool. All right. So let's look, now we're going to look at the compound interest on those 2 different ways to deploy $1 million in capital, correct?
Yeah, let's talk about it. Let's talk about appreciation. And before we talk about the ways in which we can make appreciation happen, let's just assume 5% every year appreciation. So let's say that we buy a piece of property first for $1 million, and we're going to get 5% a year appreciation. And let's do these examples, Jack, on a 10-year time frame.
Okay, cool. So we got a little calculator up here. Let me flip to a new slide, but we're going to visualize the difference between something you're in for $1 million in cash, right? Mm-hmm. Versus this scenario. I'm just going to make these smaller for illustration's sake. Okay. 250 times 4, and we're going to do 10-year compound, right?
Yep.
Okay, so let's do the million in cash first. We got a compound calculator here, courtesy of the US government. Thank you very much. So, a million, no monthly contribution. It's just sitting there, right? 10 years, and we're going to assume an interest rate of 5% annually compounding. So that leaves us with 1.6 and change.
Yep. So our original $1 million investment 10 years later, 5% compounding appreciation every year gives us $680,000.
Okay, so this is 1.6 million, but you're in for $1 million. So you're like the net value or the net increase in value is 628 or so.
Yep. So you've realized 628K of value creation.
Okay, all right. Now let's do it for this guy. And I think we need to go into the fundamental difference here, which is the entire value of the asset is appreciating, correct? Even though, so your
bank
equity,
foot the bill, yeah. The bank foot the bill for 75% of it, and you only owe that, that unique number that they put in. You only owe them that $750,000. That number that you owe them doesn't grow over time. So you realize 100% of the appreciation, but you only put in 25% of the equity.
So the same appreciation curve is happening. So that net, am I calculating this right? The
1.6 million.
You net this 4x in this scenario.
Yeah, you've turned your $1 million investment into 2.4 million in equity on all these buildings, because now you have, that's an addition actually to your original investment of $1 million. So you actually have 3.4 million because you owe 250,000 and each of them are worth 1.6.
So here's the next piece, which is obviously you're returning the capital to the bank, but that is something you calculate in the operating income of the building. How do you think about that?
Yeah, for this example, we're going as if this is an interest-only loan, and the bank, the amount that you owe the bank stays the same forever. But over time, when you own an asset for 10 years, you do pay back a lot of principal, but we're not including that in these calculations for simplicity's sake.
Okay.
So we put in the banks. We also still owe the bank $750,000, but each of our assets is worth 1.6 now. So if you subtract the 750 grand, we have 850,000 in equity in every single one of our buildings. You multiply that by 4, it's $3.4 million. So yeah, we turned our $1 million in equity over 10 years into $3.4 million instead of 1.6. So that's just the power of using bank leverage and realizing appreciation on that.
Let me know in the comments here if you're feeling like you got this piece as well.
Yeah,
I think I'm there.
People are doing a good job kind of additionally explaining what we're talking about as well.
Okay, awesome. All right. So let's go back to the agenda, Nick. I think we're on operating real estate. So I think if we can continue this story, assuming we have those 4 properties, and start to talk about the economics of each property.
In the first example, all we did was assume straight line 5% appreciation. But the great thing about real estate, as we know, is that net operating income can be in our control. And I think about real estate as a small business. I don't think about real estate as something passive that people just buy and it sits and it appreciates slowly forever. I think about it as, hey, look, what can I do to bring in more revenue or decrease my expenses? I'm operating this thing as a business. This is not just a piece of property that's going to sit there. I'm buying a piece of property. I'm buying a self-storage facility, and I'm saying, hey, how can I make the experience better for my customers so that I can charge more money? Or where can I spot inefficiencies in a market where I can charge more money to buy an asset? and hey, how can I come in and lower my expenses so that my net operating income goes up? And when you can do those things, real estate gets insanely powerful, as you're about to learn.
Cool. So let's say, for context, in $1 million storage facility, how many units would that be, just roughly?
Let's just say 100.
So 100 units in here. I'm just going to, I might not even 1, 2, 3, 4, 5, 6, 7, 8. Oh, whoops. 10. So the way I would think about this is like trying to extrapolate it from that single customer experience, or what is it about, what are the costs associated with serving one customer, in the same way, you know, small business would talk about acquisition cost, and like the margin on whatever it is you sell operates the same way here, correct?
Yep. So let's use an example that every single one of these customers is paying us $50 a month to rent a storage unit.
Yep.
So that's $5,000 a month times 12. That's $60,000 a year. And let's just assume, for an example, that we spend. Actually, we need to charge more money to get this example to work. Let's do $100 a month per customer. So that's $120,000 a year in revenue. And let's say we have $70,000 in expenses, so we're bringing in 50 grand a year. We bought this thing at a 5 cap. $70,000 in expenses, and we bought it at a 5 cap, so for $50,000 in net operating income. Beautiful. Now let's say we spot, the first obvious reason is, you know, what I do is I try to spot an inefficient market, meaning every single one of these units is rented, every single one of them is bringing in $100 a month, but the market price is actually 5% higher. So on day one, we can raise the prices 5% without doing a whole lot, just because of supply and demand. So let's say now we're able to charge $105 a month to all 100 customers. So our monthly revenue turns into $10,500 times 12, turns into $126,000 instead of 100.
Yep. And this
and
is
our expenses,
assuming your
expenses
costs
stay the same.
Right.
Yep.
In that scenario, so then we're at 56, right?
$56,000 net operating income. Yep. And if we divide that by a 0.05, because it's a 5 cap, our property right off the bat is valued at 1.12 million instead of 1 million.
Beautiful. And we haven't talked about reducing our operating costs either, correct?
No, or making the experience a little bit better for the customers, and having a marketing campaign to bring in customers. We're buying self-storage facilities often from people who are 100% full. They have sub-market rents. They don't have a website. They don't allow easy rentals. And they also spend a lot of money for an on-site manager, when you can kind of put software in place and manage a facility without those things.
So let's talk about the levers on that. So you have
the big lever for me is supply and demand. Yeah, let's talk about these things. So if you have $70,000, is that the expense?
Yeah, I was doing it from the expense, but let's just talk about levers instead of that. Supply and demand is what the market is paying wherever you are, right?
Yeah, that's the big one. If you buy from some unsophisticated operators, people who don't necessarily know how to manage, you can find big holes in supply and demand, where, you know, market rent may be 20% above what they're charging instead of 5, as we exemplified.
Okay, that's one. So this is a play to increase revenue. So different levers will obviously have different effects. So this is a revenue lever.
Another revenue lever is the customer experience. How you have a better customer experience, which means maybe a nicer storage facility. You renovate it. In multifamily, it could be renovated, granite countertops, whatever it is. It can also be ease of access. For self-storage, it's ease of rental. How easy is it to rent a storage unit in X town? And many times the operators do not answer the phone. Many times they do not have a good marketing campaign, and they can't necessarily increase they can't charge more money because it's not easy to rent.
So this is, someone checking out two different storage facilities and being like, oh, this one's easier to get into, or people are better here, or the check-in is easier. I can unlock it by my phone or whatever. I'm going to pay an extra $10 a month for the ease of use. Cool.
Yep. Now let's draw a line and go down below the line to expenses. Now there's a couple levers with expenses. And it's the main one is cutting costs with efficiency. Like many of these small business owners operate these things like it's 1985. They literally use fax machines and handwritten ledgers, and therefore they have a lot more human expense in what they're doing and how they're operating. So my main play is we buy a self-storage facility and we're gonna make it really easy to rent, and it's all gonna be online with a piece of software where you pull up to a gate, and instead of meeting with a agent, you are pulling up your phone and renting a unit right on the spot. And so we can save sometimes 20, 30, 50 grand a year in human capital.
Okay, so that's a expense lever. What else we got? I'm gonna put tech for this. Yep.
Yeah, it's all that. I'd say that's the main one, is the human capital. It can also be maintenance if you upgrade some things and you don't have as much maintenance expense.
Is there an argument for, if you own multiple properties, you consolidate your expenses in other ways too, like your accounting, your legal,
economies of scale?
Yeah,
exactly right. When you have 4 properties and not just one, you can have one customer service rep answer the phone for all 4 instead of one customer service rep answer the phone for one. Exactly right. Same with your software packages and your marketing and the brand awareness and all of it.
Yeah, I'm doing a person here, but this could be software or anything.
Yep. Let's do a pretty realistic example of what we look for and buy in a self-storage facility, and how we finance these things, and how we carve out equity and do a cash out refinance.
Okay.
So let's say we buy 4 properties for $1 million each. We deploy $1 million cash. We're going to buy 4 self-storage facilities for $1 million each, but we're going to bank finance 75%. And each one of them, we're going to value these. I buy around an 8 cap, so we're getting about $80,000 in net operating income.
Mm-hmm.
Generally about 100,000. Well, let's say 120,000 in revenue and 40,000 in expenses at each facility.
All right. I'm drawing out each of these. Probably people don't need to see all 4 of them, but just trying to idiot proof it for myself. Say that again, the operating income.
So let's say 120,000 in revenue and 40,000 in expenses. That's very realistic for what we do.
Okay, that's how we get to the 80.
Yep,
Right.
but I've spotted 4 properties where the market rent is 20% below where it should be, and that's fairly often that happens.
Okay, so these 2 are undercharging by 20%.
Yep, let's do it. And also, so what we're going to do is we're going to increase revenue, and we're going to wrap it in technology so that we can charge more. But our 120,000 in revenue turns into $144,000 in revenue at all 4 facilities.
Okay, at all 4. 144, you said?
Turns into 144 in revenue. And let's just say we aren't able to cut very many expenses, because with many of them are mom and pop operators that don't have managers in the first place. So let's just say this is a revenue play only.
Mm-hmm.
So our expenses stay at 40 grand. So our net operating income goes from 80K in net operating income up to 144 minus 80. Well, let's see here.
Which would be 64.
It's actually 104,000. 104,000 in net operating income instead of 80 now.
Okay. Per property.
Yep, per property. And now we value them at a 8 cap.
Okay.
So they're worth 1.3 each now instead of 1. And it takes about a year. It takes about a year to stabilize revenues at the new amount. So if you put in 750,000 of bank debt from each one, your new equity is now 555,000 each instead of 250. So you actually doubled. So while you only increased revenue by 20%, you've more than doubled the equity that you have in the asset because of leverage.
What did you say that was? What number was
$550,000 of equity now in each building. So that 250 is now 550 from one simple 20% revenue increase.
All right. I think that diagram makes sense. That transition from top to bottom.
It does.
And
it does.
At the top, we're at 5, right? 5 cap, you said?
No, 8 cap in both. It's an 8 cap in both. Yep. We bought for 1 million. We were making 80,000 in net operating income. Now we're doing 104. And the 550 is the new equity that you have in the asset. It's not the value. That the new value is 1.3 million, but you put in 250,000 and you borrowed 750. Remember, so 1.3 minus 750 is your new equity. 1.3 minus 750 is the 550,000 in equity. So now let's make a new slide and let's talk about how you can use leverage to ramp this up a notch again. So we put $1 million into these 4 assets and we've increased the value to 1.3 million.
Okay, so these guys are now 1.3 million each. Got it?
Yep. So we can now go back to the bank and we can say, hey, look, the value of these properties is higher because they're making more money. So we're going to Mr. Banker, we're sitting in and saying, hey, look, we increased the net operating income from 80,000 up to 105,000. They're making more money. It's worth a new amount of these facilities are worth more.
Okay.
So now Mr. Banker sends an appraiser in and the appraiser agrees and so they look at our books and they see our revenue coming in, they see our expenses going out, and they say, okay, you're right, it's worth 1.3 million.
Mm-hmm.
And they can, and the beautiful thing about real estate is the banker doesn't care what you paid for it. They don't care what anybody else thinks it's worth. You know, they care about how much money it's making. How much money is this making? And they use a cap rate comparable. So if they're going to value it at an 8 cap, they look at that $105,000 valued at an 8 cap, it's worth 1.3, and they'll loan you 75% of the new value. And that's the powerful part of all this. They'll now loan you 75% of the 1.3 million, which is 9.75 million.
Times 4.
So we have a question: who determines the cap multiplier? And it's nuanced. Again, it's about risk. It's about market. You can use comparables of what other people have paid for certain assets based on the net operating income of those assets. It depends. And it's when we go to talk to an appraiser, when we're trying to get our 3 facilities or our 4 facilities refinanced, there's a little bit of a balancing act, right? It's kind of, okay, you know, this is why we're going to try to find some comparables. We're going to, you know, try to convince them that an 8 cap is market, maybe a 7 cap is market when you have 4 of them together and you put one big bank loan on all of them, and you can amplify this even more. But let's say the appraiser agrees that the cap rate is the same as what we bought it for. We'll value it at the same cap rate that you bought this thing for. So we pull out $975,000, but remember, we only had $750,000 on our original loan. So we use $750,000 of that $975K to pay off our original loan. And we are left with $225,000 in cash that comes to us. And this is called a cash out refinance. This is cash above and beyond what was used to pay off the previous loan. So here we go. We just bought 3 properties. We put $1 million to work. We bought 4 properties a year ago with $1 million worth $4 million bucks. We increased them to be worth 1.3 each. We went back to the banker. We paid off our original loan with our new debt, $750,000, and we had $225,000 left. Multiply that by 4. You got $900,000 of your original $1 million back now. and you still have 25% equity in these assets. And this is what's called a cash out refinance. And it's how you can supercharge a real estate portfolio, because now I have $900,000 that I can go buy 4 more buildings. Remember, I still own those 4. I still own those 4 assets worth 1.3 each. And now I have $900,000 coming back into my checking account. That is, if it's recourse loan or qualified non-recourse debt, I can use this however I want without it being a taxable event as well. And I can go buy additional storage with it. So now 1 year later, we have $900,000. Guess what, Jack? You and I can go buy 4 more self-storage facilities for $1 million and double the size of our portfolio.
Wow. So we'd be at 8. We want to continue this story here, or are we going to go? I'm just thinking what we had on the agenda as well. Sounds like I think we ripped through most of this.
We're ripping. We might be able to take some Q&A here. But
I'm going to just visualize the 8 here. So you have these. This is basically, these 4 are then starting where we started with the first 4. So you're then going
so those are worth $1 million each. Yeah, those are worth $1 million each.
And these
so
are $1.3
$4 million on the bottom line.
Yeah.
Yep. So the top is worth 5.2. Top row is worth 5.2 total. The bottom row is worth 4 million total. And remember, you have 25% equity in all these things too. So 5.2 plus 4 million, that's the value of our entire portfolio. We now have $9.2 million worth of real estate under management. So we used $1 million and now we own $9.2 million worth of real estate. And we have 25% equity in that. We have $2.3 million of equity. We turned our $1 million in 12 months into $2.3 million worth of equity. And that's why this is so powerful. If you can find a way to operate real estate and increase net operating income, it gets more valuable and beautiful things happen because you're amplifying these gains. You're amplifying these gains with leverage.
And realistically speaking, you said the portfolio of 4, that would happen in a year. You can make that happen in a year.
Yeah, we bought 4 properties last year. Yeah, you can do that in a year. Yeah, and one of them might be worth 2 million at an 8 cap. One of them might be worth 700,000 at an 8 cap. It's very rare to find them all at exactly $1 million. But this is how real estate portfolios turn into empires over time. Because if you hold on to them for 10 years and you increase revenue every year by 8% and expenses only increase 5% every year, the net operating income bounces by 10% every single year, which means your value is bouncing by 10% every single year. And over the course of 10 years, you have a property worth twice as much.
Awesome, man. I think we've probably got at least 20 minutes worth of questions here. So I can illustrate where I can, but I think jump into the Q&A, Nick, and call me in if you need me to draw anything.
Yeah, let's talk about how this can work the other way around, right? So revenue is the almighty risk factor in real estate. When I'm looking at an asset, when Jack is looking at an asset, when you are looking at an asset, anybody, you should be thinking about revenue, because when revenue drops, revenue only dropped 20%, but revenue went up 20%, but net operating income went up by, let's see, that was 105,000 up from 80,000, right? So when revenue went up 20%, Jack, the value of our property went up 31%. So that's amplified, right? Revenue only went up 20%, but the value went up 31% because net operating income gets passed straight through. Your expenses remain constant. So maybe we visualize something goes wrong, COVID happens, and we lose 20% of our revenue. What happens to our equity then? What happens to the value of everything then? So like this happened to a lot of offices and retail locations where, okay, we were making $100,000 in net operating income, but our revenue all of a sudden got cut by 20% from COVID because people stopped paying. So we went from 100K in net operating income, and that might be on $200,000 of revenue. 100K in net operating income might be on $200,000 of revenue. And if that drops by 20%, that's $40,000 down to net operating income. So if your revenue of 200,000 drops by 20%, that's 40 grand, and your expenses stay the same. You still got to pay all the expenses. So your new net operating income literally drops by 40% down from a 20% revenue increase. And therefore the value of your property drops by 40% with a 20% revenue decline. So this is a snake that bites both sides, right? It can amplify your yield, or it can absolutely crush your equity if revenue drops. So revenue is the almighty risk factor for me. If I'm looking at a deal, I'm looking at revenue assumptions. How high can I raise revenue? How fast can I raise revenue? Or what are the odds that revenue goes down? What would have to happen where revenue goes down? And everybody in the office space, in the hotel space, and in the retail space just saw revenue get absolutely crushed. And when revenue gets crushed, that scares everybody off. So not only did the net operating dip, but the cap rates are not the same anymore, because nobody's going to pay the same amount of money for the same amount of yield when the risk is way higher now. You know what I mean? Feel free to chip in any questions.
No, it makes sense. So I didn't catch the value of the property, but I think that'll really drive the point home. So if we could just lay that over the top of it.
Let's do the value. So let's say it was valued at a 5 cap. Let's say this office building was in downtown Boston, and it was like a super safe, Class A, amazing property that was worth a 5 cap, and it was doing $100,000 in net operating income on 200,000 in revenue. So if it's doing 100,000 in revenue or in net operating income, and it's at a 5 cap, that's worth $2 million. This asset is worth $2 million. But then our revenue just got chunked by 20% because one of our tenants stopped paying. A bunch of people moved out. And guys, it was way worse than this. It was way worse than this in a lot of markets. Hotels went like zero. They went to nothing in a lot of markets. So it was worth $2 million at a 5 cap. But then COVID hits, and okay, now people stop paying rent, and our net operating income drops to $60,000. What happens then? Not only is it not worth a 5 cap anymore because investors aren't willing to pay 20x anymore for that same amount of value, maybe it's now a 10 cap. Maybe it's now worth a 10 cap because the risk associated with this is drastic. So $60,000 of net operating income now divided at a 10 cap, this $2 million asset is worth $600,000.
That's a sleepless night right there.
This is how real estate portfolios come crumbling down.
And this is an argument for self-storage as an asset class, presumably.
Yeah, I mean, this is an argument for just the risks of doing business, right? The people who survive, the only people who can survive this, because your 60K in net operating income now cannot cover your debt service, because remember, we have bank loans on this that we got to cover debt service. We haven't even talked about debt service at all. Our debt service on this $2 million asset, I'm going to do a quick amortization calculator here. If we have a $2 million asset and we have 1.5 million in loans, and it's at a 4% interest rate, 25-year term, our monthly interest payment is $8,000 principal and interest. So 8,000 times 12, we're spending $96,000 a year to service our debt. We got to get debt cheaper than that. Hold on, because the people who buy 5 caps can't get normal debt. They need to get it at 3% interest rate. So let me run that again. All right, let's say your interest payment is $1,000 a month. You get 2%. You got a 2% loan at 1.5 million. That's crazy. It can't be right. No, that's not right. 1.5 million, 3% interest rate loan, 25-year loan term. We are making a monthly payment of $7,000 a month times 12, $84,000. So we're spending $84,000 a month to cover, or $84,000 a year to cover our debt.
Yeah, we're making 60 grand.
We're only bringing 100K net operating income in the first place, right? So that in good times, we were making $16,000 a year in cash flow. This is a cash on cash yield. But in bad times now, we are underwater. We are hemorrhaging $24,000 every single year to cover our debt. So if you don't have cash reserves to make those payments, what do you do then?
Borrow money at a horrific thing, right? Or declare bankruptcy.
You sell these assets for 600 grand and you get out and you start over. That's what real estate investors do. It's a sad deal.
Yeah, and
so that's the risk. That's the risk of all this.
And if this happens across a levered portfolio, this isn't happening once, it's happening 8, 10, 20, 50 times in some cases.
Yeah, you owned a bunch of properties that were worth $2 million and you had 1.5 million in debt on them, and all of a sudden they're all worth under $1 million and you still have 1.5 million in debt on them. So you have a bunch of properties now. Let's say you have a $100 million real estate portfolio, you have 75 million in debt. Now all of a sudden you have a $50 million portfolio with 75 million in debt. And that's when you hand the keys back, you give them your car keys, you give them your house keys, you give them access to all your checking accounts, and you are done. You're toast. And that happened to so many people in 2009, 10, 11.
Wow. Well, this has been a real schooling, man. Is there anything else we can, I mean, I'm just curious, for knowing that, like getting into this yourself, is that a lesson you learned in practice, or is that just studied it well enough to avoid it?
Yeah, luckily we were in the self-storage business, so we never had to deal with revenue problems. But we are not, the other problem is that people over-lever and borrow. So cap rates are very, very closely associated with interest rates, because when interest rates are low and you can borrow money cheaper, you can buy lower cap rates. Because if you buy a 5 cap and you're borrowing money on 6% interest, the cash flows don't work. But if you can buy 5 caps if you can borrow money on 2% interest or 3% interest and still have cash yield. So, every real estate investor, including me, has to think about, hey, what happens in a world where inflation takes over and interest rates go up to, 5, 6, 7%? Or when in 1975 in New York City, they went up to 8, 12, 13% interest rates, and everybody lost their buildings. They were literally handing the keys back to all their buildings in New York City. The banks took them all back and they were giving them away for pennies. It's extremely cyclical.
All right.
So
should we get into some questions here?
It's fascinating. Let's do it.
You see Q&A in your thing. I would
I do.
pick a few out. There's more than we can get through, I think. But follow Nick on Twitter. I'm sure he can answer a lot of them, or he may already have.
Yep, I guess the tax advantages here are interesting too, because the way depreciation works the same way as leverage, right? And appreciation. So you can write off a portion of your expense every single year. So if you just go back to the very beginning slide where we talked about that 5% appreciation, it works exactly the same. So you're going to get a depreciation expense on the entire purchase, whereas the bank covered 75% of that. So it can be really, really powerful that way too. Yes. Yep. So the bank covered most of it and the value is going up, but you also realize, you can write off a portion of that expense every single year against your taxes based on the entire value, not just what you spent money on.
So it's essentially a multiplier on your deductions as well.
Yep. It amplifies everything. Amplifies your risk. It amplifies your reward. It amplifies your appreciation, your tax advantages. And, everybody in real estate loves debt, but, and for the past 10 years, levering up and getting all kinds of debt on your entire portfolio has worked wonderfully for everybody, because interest rates stay low, values are staying high, values are increasing, revenues are increasing. But anytime anything happens, when the tide goes out, you see who is swimming without shorts on, and the people who aren't well capitalized, they're the ones that are not able to absorb these little hiccups.
And what happens? What's happening to the hotel industry, for instance, right now? How on earth is that ever gonna? How do you recover from that? To use the Tiger King.
So we were talking about debt service and how their debt service might be $90,000 a year while their net operating income is 60. They are really counting on the bankers to not charge them any payments. They're not making payments to the bank right now. They're not paying the bank, which is the insane part of all this.
That is crazy.
And as soon as the bank says, hey, we're not going to do this anymore, you got to give us the keys to your hotel or pay us, the bank's going to start taking back a bunch of hotels, and it's going to get tough. It's all very cyclical. It's all very cyclical. This entire game of real estate is incredibly cyclical. So if you can use real estate the right way and your assets are getting more valuable, it works phenomenally well. But as soon as a hiccup happens, it can be a very, very hard time for an entire industry. And that's exactly what retail and hospitality are going through right now.
And the banks are exposed too, right? In a lot of ways.
Yeah, so that's why a relationship. I mean, we can talk briefly about what it means to get a loan. I mean, you're talking to a banker who needs to be okay with your risk profile, because the banker knows that if times get tough, he doesn't want to take a building back. No bankers want to take a building back. They want you to make money. They want to make money along with you. So, when you're going to get loans, you have to really sell them on the fact that, hey, look, this is the risk adjusted deal here. It all makes sense. And, there's a lot more likely chance that we're all going to make money than all of us lose money.
And your like portfolio of skills as a real estate investor, that is a huge part of it, I would assume, your ability to negotiate, to borrow.
Exactly. Yeah. You have to get bankers on the same page as you. And it's really just selling them on my vision and my ability and my attention to detail and how much can I really drive revenue. I mean, when you're a real estate investor, it's all sales. You're selling the bankers on loaning you money. You're selling partners on investing with you. You're even selling people on buying letting you buy real estate from them.
And how much room is there in that? The rates at which you can negotiate, obviously there are federally mandated interest rates, but the risk profile is obviously gonna, if you're starting out, for example, how much more are you paying for money than somebody who's 10 years into the game?
Yeah, exactly right. So there's also, debt is very complicated and as far as there's rules and fees when you repay the debt back. So an example is like me and you, Jack, we go buy a self-storage facility. We plan to do a cash out refinance in a year when it's worth 1.3 instead of the 1 we paid for it. What happens to that old loan? How can we pay that old loan back? And there's fees, there's prepayment penalties that you negotiate yourself into or out of based on when you decide to pay it back, because paying back that original $750K, there might be a 5% prepayment penalty on that thing, and you got to pay almost 40 grand to do the refi. So it's a big negotiation based on your overall strategy of what kind of debt you get, what kind of terms you get it at. Is the interest rate most important to you? And if you're going to hold it for a long time, interest rate is the most important thing to you. But if we're going to do a 1-year cash out refinance, the prepayment penalties and how we can get out of this loan are just as important as the interest rates that we pay going in. So it's a big negotiation based on your strategy when you're taking on debt. So where can people learn more about you, Jack?
Twitter is the place.
I feel like there's a lot of followers. There's a lot of people in this thing who have followed me, but don't know much about you and what you do.
Yeah. So definitely Twitter is a good place. I'll write that on here. Just at Jack Butcher. But one of the things that I'm interested in, one of the things that I've been doing for the last 5 years or so is working with people like Nick or studying stuff on my own and trying to translate that into some visual, increase the velocity of an idea by visualizing it really simply. So if you can get somebody to if you can get a visual that represents a concept, what I've learned in my career is you can really speed up the understanding of something. So concepts like real estate, things that I've used to grow my business have all been things that it's all been this little methodology of making things simpler with visuals. So it's a nice mental challenge to get on. And when you know nothing about something and try and look at it through the perspective of somebody that doesn't understand it and visualize it.
Yeah, it's awesome. I love following along. But yeah, this is just one concept for if you know me and what I do. This is one section. And you want to share the screen?
Yeah, let me do it.
I've been working on a project recently. I don't want to spend too much time pitching this, but I've been working on a big project where we give examples and real life concepts of real estate in a usable way. That's my goal recently is to get something out of, hey, this is what I wish I knew about real estate when I was 25 years old, about to go buy my first property or build my first self-storage facility.
Yeah, and just for context, we basically did this. We did a fraction of this chapter, and this is the table of contents for the whole thing. So there's we could do probably a month-long retreat visualizing this thing.
Mm-hmm. Well, I appreciate you having me, Jack.
Mate, it's
I
an
don't see any
absolute
other
pleasure.
questions that pop right in here. A lot of stuff on self-storage, a lot of stuff on the ins and outs of some different things, but I think we did a pretty good job of. Did we do okay, guys? Let us know.
Yeah, let us
people
know.
left, so
let us know. Yeah, this was awesome. I recorded it on my end, and I'll get it out. Nick, you put it on YouTube. I can put it on YouTube. We'll get it to people, and we'll send a link out to everybody that RSVP'd. So if anybody's listening to this and you didn't catch it live, thanks for watching.
Well, Jack, appreciate it, man. Thanks for having me. I feel like I'm playing the big leagues now because you're quite a bit ahead of me in this stuff.
I don't know about that, but I appreciate it. It was good fun. Thanks, mate.
All right, we'll talk soon.
Thanks, everybody. Chat to you soon. Bye-bye.